Hi there, Don Meredith. I wanted to share a presentation that I normally do at the country clubs and at the inn at Rancho Santa Fe. But since you can't all be there, I wanted to do this video to kind of consolidate what I think is a very powerful message and observations. I come from a trading background and an observer of a student of investing, both income, both real estate and stock markets. I want to bring to you some observations of looking at many hundreds of investment portfolios, basically share with you my observations. We have a front row seat to now see what has worked and what hasn't worked over the years. The last 2 years have been very intense. We have seen a stock market crash. We've seen an economic crash. In March of '09, we reached a low that was critical. I mean, it was so critical that the Senate and the U.S. Treasury were meeting behind closed doors, and what went on there was literally we were days away from heading to the Great Depression. So as Warren Buffett said, when the tide goes out, you can see who's been swimming naked. Any investment that was weak generally failed. And so we have a real front row seat to what worked and what didn't work. Basically, what I'm showing you here is that in 10 years in the stock market, that we are exactly where we were 10, 11 years ago. So that means an investment with all the worry, with all the risk, with all the sleepless nights of your 401ks, of your investing, has represented many people that are in the stock market. So I want you to look at that human scar, because that's what it is. It's a human scar on the psyche of the economy and the market. And remember that in 10 years, the stock market has done absolutely nothing for anyone. It's my feeling that it is now a flawed strategy. So our job one is to protect your principal and stay safe. Real estate is about cap rates. It's about value. It's about income, tenant strength. It's about absolute cash flow. And we'll get into real estate versus stock market. So back to our chart again. It's simply showing the start of the crash in 2008. And many people had to get out at the bottom. They were just looking at 60, 70, 80% losses. And then the computers took over. When it looked like we're at Armageddon, the computers took over for the most part. Derivatives and algorithm trading kicked in. So most people didn't participate in that. And the people that held through it, well, they had a lot of sleepless nights. Basically, as I look at people's investment portfolios, they're not making a lot of sense to me. They're redundant, they're risky, and I think they're way riskier than people had in mind when they set them up. If you just take the simple philosophy that 95% of the stocks follow the broader market. So when I see a portfolio and it's all in either with mutual funds or 20 to 30 stock positions, I don't get that. To me, that's very unmanageable, and it's just redundant when you could have one or two positions. You know, I always go back to Kiyosaki, the author of Rich Dad, Poor Dad. He says, I wouldn't invest in anything that didn't generate passive income. I just don't see it. And I think we have to get back to that core thought. Now, if you want to stay in the market, here's a couple of ways to stay in the market and really get some bang for your buck. When I see all these mutual funds and 401ks, $500,000, $100,000, they're all in a very sluggish mutual fund. What that shows me is you're at tremendous risk. And even if the market goes up substantially, you're going to see very little gain. You need the perfect storm. You need the economy to be cranking. Everything has to be working for a stock account to work. And our real estate investors and our Kiyosakis of Rich Dad, Poor Dad fame have said, look, we only want things that generate income. The fact is, income generation works in all economies. It doesn't need the stock market. And if you have a good enough core investment, your investment can generate income even in horrible economies. I want to show you something here. This is a real estate trust. It's the best of the best. If you and I bought a Home Depot and it was paying us 7% income, there is no way Home Depot can get out of that lease. Let's say we had a Home Depot with a 20-year lease, and you and I as a group bought this property. Home Depot, as you can see in this chart, has $58 billion in revenue in the worst year since the Great Depression. They were actually opening stores. So you can actually buy a real estate trust with the globe's leading companies. If you have a property like this, if you're buying a property that has a 20-year lease and permanent financing or no financing, we often represent investments where it's all cash. There's no financing issues whatsoever. Leverage is the thing that hurts real estate. We saw commercial property that came down for the first time since the Great Depression, 25 to 35%. You can now go into the best institutional grade property with the best tenants in the world, with the deepest pockets, billions in revenues. And you want to talk about generating solid cash flow? So back to the Home Depot example, if there's a 20-year lease and there's no financing due, there is no way. We proposed this in front of a room full of 28 people. There were attorneys, commercial brokers, some financial advisors that dealt with high net worth folks, and we said, let's try to make a way for this type of trust to fail. We couldn't do it because the financing's off the table. We've already lost 25 to 35%, first time since the Great Depression. They're now buying, cherry-picking properties out there in the best locations. But the reality is, real estate, institutional real estate investors have known this for years. You buy a cash flow from owning a Home Depot, and Home Depot can never move under any circumstances, even in Chapter 11. You cannot stop paying your lease. Now, you take a trust with 225 of these properties, with 20-year lease on average, and almost all cash. There is nothing that can get in between you and your monthly income. And we believe that the safety and wisdom of putting your 401k, your IRA, your money into something like this, we believe that in a catastrophic event in the economy, this could withstand anything. This would be the last man standing. In fact, now we think for the first time in history, we saw, well, in March of 2009, we saw the FDIC almost run out of money. We saw the Treasury in a panic. They had to print money. I'll take my chances with Walmart's $374 billion in annual revenue any day of the week. You put your funds in a trust that is loaded with Fortune 500 properties. You could say, well, I could buy the stock of Home Depot or Walmart. Yeah, that's one way. The most defensive companies in the world. Even in a depression, it is said that these companies will still be in business in these locations. But, you know, we want them for their deep, deep pockets. They're the deepest pockets on the globe. So, you want to buy the stock? You could. They're not running out of money. But we know what the stock market can take out even the safest stocks. You want to buy the bonds of Home Depot or Walgreens or Walmart? Sure, you can buy the bonds. However, think about it. If you buy the property, you've got a bond, AAA bond-like investment, backed by the deepest pockets on the globe. With a great distinction. With a bond, we know that a bond can go away. Look at General Motors. Even if the biggest companies in the world are your tenants, if the worst case scenario happens, you still have the property. And by the way, these companies, you can forecast out any financial problems in a company like this because they're very public. They talk about them nightly on the financial news shows. It takes years for a company like this to go into difficulties. These trusts would have the property sold long before these companies even vacated. So you look at an average lease term of 20 years or 18.8 in this example. It's absolute cash flow. This is a strategy for large investors, charities, foundations. Everybody should own it. It is appropriate for moms, grandmothers. It is one of the safest investments in the country, if not the. I don't believe that there's any way you can make this investment go away. This investment works in a jobless recovery. It is extremely defensive. It works in a horrible economy. It works in a good economy. If the stock market's up, the stock market's crash, nothing can stop this type of investment. If you knew what I knew, you would own this. It's always been our goal to bring you the best. I work for great folks and the former Price Waterhouse guys. I have a background in some of Wall Street's biggest companies. This was an absolute standout in the last couple of years when so much failed. Most of you want to retire. You want to retire with as much money as you can, mainly to convert that into income. So I say, get to the income already. $500,000 generates $2,900 a month or $35,000 a year. So for every month that you're in an investment that doesn't generate income, you have to compare that with the income this could generate. I hope this has been helpful for you. You obviously can tell how much I put into this, how much I believe in this. You can apply any math, analytics. You can apply any mathematics to this. This has worked. It's not going to stop working. If you can invest conservatively and safely, then why invest in the stock market? It just doesn't make any sense. It hasn't worked for years. I don't think it's going to work for years. Thanks very much, and we'll talk to you soon.